Okay, okay, let's take a look at common size. Now, this is where this particular class stopped for this today, ends up being the review is over, okay? This is new content. So, and a lot of times this will really throw you for a loop. So try to really focus on what we're talking about here, because it's not a difficult concept. It's not a difficult concept, but it will throw you if you're not careful. All right? Now, we're going to move into sort of an analysis mode of the balance sheet. And when we're looking at the balance sheet, one of the things, hang on one second, I need to change some display on my screen. There we go. There we go. So, when we move into an analysis of the balance sheet, now we're going to look at common size analysis, okay? And the common size just simply indicates that we're going to do an analysis within 1 year, okay? Within 1 year's data, okay? So think vertical analysis. We're staying in the same year, same time frame, but we're going to look at each item individually, okay? So when we're talking about common size balance sheet analysis, the first thing to notice here is total assets are the divisor for every single calculation that we're going to make.
So basically, everything has to equal 100%.
Correct. Okay? So total assets will always equal 100%, and when we get over here to the liability and shareholder side, that will also equal 100%. Okay? So that total asset number is, hello, wrong direction. So this is going to constantly be our divisor, and again, we're working within 1 year. So we're simply taking cash divided by total assets to get 1.9%. We're taking the $25,000 in short-term investments, dividing by total assets to get 0.8%.
That's pretty easy.
Okay? It's pretty straightforward until we get into comparative.
Don't get there.
Okay?
Stay right there.
Okay?
Stop moving.
All right. Now also look at some things. There are going to be a few things that are going to look a little bit weird though when you start doing the analysis. So for instance, take a look at our total for our land, building, and furniture. Now remember, this land, building, and furniture, those are the purchase prices, right? So when we take that $3.825 million and divide it by 3.247, we're going to get something larger than 100%. Okay? Because this total asset number is minus this very large accumulated depreciation balance here. Okay? So it looks a little bit weird that it's 117%, but that's okay. All right? Yes, ma'am.
So when you got that 117%, you did that by doing $3 million divided by the total, or you did it by adding the percentage from land and building? And
No, you should do it from the total divided by the total assets.
Don't do it.
So whatever.
Well, you can go back and you can verify by grouping it and just verifying that if you take 3.825 million divided by the 3.247, do it that way to get your 117.8%. But then you should be able to go back and add those three items above it to get to 117. Okay? So, all right. So you can verify when you're working with your percentages here. So when we're grouping the current assets, you should take the 147,888 divided by the 3.247, get the 4.6, then re-add up your group to verify that 4.6 is working. Okay? All right? Easy enough?
Do you only do this for assets and the shareholders?
We're going to do it for the entire balance sheet.
Only for common size?
only for common size, because we're looking, when we're talking about common size, we're talking about an analysis within 1 year, okay? So we're gonna look at things like, you know, total assets are 100%, what percent of that total assets is property assigned to property, plant, and equipment?
So that would be an example of a question. for
Yes.
that. So we would have all the numbers previously. and we just have to
Correct.
find- Okay.
Exactly, so,
Yeah, you might as well say something different.
Okay.
People that said Susie went to the bank and she got a bank statement that said she had current assets of this and then some other stuff, I'm gonna be mad, that's not what she said.
no, you'll get real financial statements, yeah.
How did you say you get a percentage on what benefits?
Sorry, each one of the items divided by your total assets, okay, will get you your percentage. Now, again, remember, when you're using your calculator, this 1.9% is gonna show up as 0.019, right? Okay, so don't forget, they're moving your decimal place 2 places, okay? Same thing with the liability side. Now, the liability side and the equity side, this starts getting a lot more interesting, especially on the balance sheet, simply because now we can take this number, this total number down here, and we can divide that into the total liabilities, and now we can see that 67% of our total assets are financed using liabilities. Right.
Liability and equity together though.
Because assets equal liabilities plus equity, right? Okay? So think about what's happening here, okay? This balance sheet analysis, again, does really start to get really interesting when you flip to this side of the balance sheet. Because, remember, the 3.24712 is the same as total assets, right? So when we try to figure out how much of assets are financed using borrowing versus how much are financed using equity and retained earnings, now we can actually calculate that. So when we take the total liability number and we divide that by the total asset number, right, we get 67.1%. So that means that 67.1% of our assets are financed using debt, okay? Versus when we take total equity, divide that into total assets, now we get 32.9% of total assets are financed using equity sources, okay? Stockholders and earnings. Okay? So you can see, when we take the 67.1 and the 32.9, that adds back to 100%. So now we can start figuring out, we've got all these assets, how are we getting access to these assets? Are we borrowing to do it, or are we issuing debt? Are we issuing stock to do it, or are we earning money to buy those assets? So then the question becomes,
Wait, before you go farther, can you show me how did you get the calculation, because I'm not getting it.
okay, if you take 2,178,750, okay, and you divide by 3.247,412, you should get 67.1%, okay? So then the question becomes, again, we're working within 1 year, one time frame. How are we financing most of our assets? Is it debt, is it equity, or is it earnings? It's debt, right? 67.1% of all of our assets have some kind of liability sort of attached to them, if you want to look at it that way, as a group. Okay? How are we doing as far as equity goes? Well, about roughly 33% of our assets are financed, or we got access to them issuing debt and/or earnings. So out of our equity section of our balance sheet, what are we using more? Are we using more stock issuance to finance our assets, or are we using more earnings? Out of our equity section, are we issuing more debt? Excuse me, more debt. Are we issuing more stock, or are we earning more?
No, you're issuing more.
You're issuing more stock, right? Because our cumulative earnings is only $318,662, or 9.8%, versus the issuance of our capital was $750,000, or roughly, what, 23%-ish. Okay. All right. Would you agree that that is the equity? That's issued equity, right? Common stock and our paid-in capital, right? So when we issued that stock, we got $750,000 from that stock issuance, right? Up to this point, we only have cumulative earnings of $318,000. Now, so we issued more in capital than we earned. Now, this is a little bit of a trick question, but it's going to make you think. How many years do you think that this company has been in business?
Oh, wow. Well, it would have to be within a year, right?
No. How long do you think they've been in business?
Probably not long.
Not long. Why? How do you know?
The number should be bigger.
What number should be bigger? Come on. You what? Not your paid-in capital. The retained earnings would be larger. Okay?
Oh,
So,
well, I've been looking at the wrong thing. I thought the number under that.
no. That's the total. That's the total of those three. Okay? So we can tell by the balance sheet that this company hasn't been in business all that long, because our retained earnings balance is really not that large, especially for the size of company that they are. So as we go year after year after year, we should continually build in some retained earnings here, and that should eventually overtake this financing of the capital issue. Okay? So we can look at a balance sheet and we can infer a lot of information from that. All right. So before we move on to comparative, common size. Think vertical, one time frame analysis. Okay. Then we're talking about comparative. Now, when we're talking about comparative, think horizontal. Okay. Now we're talking about what happened last year versus what happened this year. Okay. The other thing that we've got to keep in mind is this. One, GAAP requires, again, this is an old version, but right now, GAAP requires 3 years of financial statements. Okay? Not just 2. So in this one, now we're looking at 2 years. Okay? We're looking at December 31 X2 and December 31 X1. Okay? So which one is the more current year's information? X2. So the first column, so when we present comparative financial statements, we put the most current information in the first column, and then the older information in the right-hand columns. Okay? So you can see when we start doing analysis across time periods, we now can, number one, we start with what is the calculated difference. Now ignore the percentages column first. We calculate the difference. So we can see last year we had cash of 61,506. This year we had cash of 58,500. So we can see we got a reduction in cash of $3,006. Right? Everybody good? Okay. Let's keep rolling down this dollar change column. Well, short-term investments didn't change. How about our accounts receivable? Well, accounts receivable actually went up. Okay? So it went up from 38,840 to 41,96. So we had an increase in accounts receivable of 1356.
It went down, then it's in parentheses, right?
Correct. So if we have a reduction, put it in parentheses as a decrease, okay? So then we can also look at total current assets as a group. So we went from 47,654 to 47,888, so we had a net increase of 234, right? Everybody good with calculating that? Easy enough, right? Okay. We simply take last year minus this year. Just be careful though when we're indicating whether it's a positive change or a negative change, because we want the change indicated, positive or negative, from last year to the current year. So however you get the difference between those, the number is fine, but we do need to indicate a negative change or a reduction in the balances in parentheses, okay? Now, here's where comparative analysis changes from common size analysis, okay? When we get to our percent change over here, we're staying on that line that we're working within, okay? So to get that 4.9% calculation here, we're taking the $3,006 and we're dividing that by the 61,506. Okay? So
Are you dividing it by the 61,506 because that's the bigger number, or is it?
no, we're going to divide by last year's number.
Okay.
Okay? So it doesn't matter which number between these two is larger, it's we're going to divide the change by the last year. Yes,
Oh,
ma'am?
that's how you get the percentage?
That's how you get the percentage.
Okay.
Okay?
So you said that now that there's supposed to be 3 years, are we gonna have to work with one of those?
No, I'll only do 2 years.
Okay.
Oh,
Yeah. Okay?
oh.
All right? But the biggest thing here is just be careful when you're calculating your percent change, because a lot of folks, they're fine with getting this column of dollar change, but what they will do is they want to take this dollar change and they want to divide it by the current year dollar amount. Yeah, don't do that. It's dollar change divided by last year, okay?
This is only for the
Comparative, okay? So again, when you're looking at common size, vertical, stay within the same time period. When we're talking about comparative, think horizontal, we're going across time periods, okay? So what we can do here when we're looking at the analysis, now we can start looking at it, it's like, oh, wait a minute, we had a reduction in cash, it's like, it's like, that's not good. What was up with that? Well, part of the reason why we had a reduction in cash was because we didn't collect as much in accounts receivable. So as accounts receivable starts going up, think about what's happening. We're selling stuff, but we're not collecting on it, right? So that would explain a big reason of the explanation of this $3,000 reduction in cash. We're selling, but we're not collecting as well, okay? Let's see, where's some other things to look at here? Let's test you on how much you remember from last semester. Can somebody explain to me Okay? Because again, you can calculate the numbers all day long, but if you can't explain it, that becomes a problem. Okay? And remember, if you can't explain it to your boss, the last thing that you do when your boss asks you a question is start a sentence with, you say, let me get back to you on that. Okay? All right, so leasehold improvements. Okay? Remember what those are?
We just talked about that.
We didn't talk about leasehold improvements. Oh, I was thinking that we did.
Okay, China glassware.
All right, we talked about china, glassware, and silver though, right?
Yes.
Okay, all right, let's talk about china, glassware, and silver. Tell me why china, glassware, and silver went from 49,403 to 36,524. We're gonna talk more about
Stuff
leasehold
could have
improvements.
broke, got lost, stolen.
Good. So all of that could have been broken, lost, misplaced, whatever it might have been, but something happened here. Now, I'm just saying, does this concern anybody else?
Yeah, that's a
little
big
bit?
number.
That's a big reduction. It's like, what the heck? We went from almost,
It's in my
$50,000. We went from $50,000 down to 36. That's a 26% decrease in our china, glassware, and silver.
Somebody's getting fired.
Yeah, I was gonna say, who do you think is gonna get nailed for this one?
The waitress.
Well, I don't even think, the only people that come into contact with it mostly are gonna be dishwashers and kitchen staff.
Okay? So we're going to hunt that down and figure out why we've got a 26% decrease.
You ain't breaking that many dishes.
Yeah, somebody's walking off with something, right?
That,
You don't
you know
break
what?
that
I
much.
bet the original Pancake House has that number from the amount of mugs that get stolen from there. Considering I took at least 2 every time I go.
Okay, so you kind of getting the idea here? This is where accounting starts getting interesting, is when you start looking at the numbers and then you've got to start explaining what's happening here, okay? All right, how about,
It was even seriously long.
all right, let's see. Let's look at inventories. Let's look at inventories. Inventories went from 10,143 to 11,000 this year. You think that's good, bad, or indifferent?
Well, you purchased more things, but
You didn't sell it.
Bingo. We purchased stuff, but we're not selling it. That's the reason why it's still sitting out here on the balance sheet, right? There's only 2 places inventory can be. It's either sitting on the shelves waiting to be sold, or it's with the customer sold, right? So if we're increasing in inventories and we see this, what should we expect on the income statement? A decrease in,
Income? What we're taking for?
not necessarily income,
sales.
sales, right? So if this sort of trend continues year over year, we've got a problem. Either we're buying the wrong inventory or overall sales are down, okay? So if we are, in this particular case, we are a Hotel Doro. Now, most of the inventories for this company are going to be things like food. Now, we're going to talk about Hotel Doro and the kind of food that they have in a later chapter. But,
Fictitious hotel.
yeah, it's fictitious and it's just insane, okay? But we've got a problem here. We're buying food that's not being sold here, okay?
I want to look at Disney Paris's.
Either you can invest on advertising to get more of your business out there, so more
Okay.
customers.
I'm sorry, say again?
You can either invest like more in advertisements, so people can, more customers can come in, so you can make more sales, or you change your prices, so more people can be interested in the prices that you have.
Perfect. Perfect. Everybody get that? We either gotta go on a marketing campaign to get those inventories sold so that we can make money, or
Prices.
we've gotta adjust our prices, right? Maybe our prices are too high and people don't like the fact that our prices are too high. So that's the reason why that is possible too. I mean, maybe we have had something happen. I mean, I'm not gonna lie to you. One of my favorite restaurants here in Charlotte, no.
Come on.
One of my favorite restaurants here in Charlotte, they're not, their food used to be really consistent when the oldest owner of the restaurant was consistently there. And now that he is not consistently there, the food's not as consistent, it doesn't taste as good, and it's like, we don't go as much, right? And then every once in a while I go, oh, let's go give it a try, and then it's like, right? Because it's not the same. And that's going to be some things that you're going to have to be thinking about, and you're going to have to be able to analyze and look at financial statements to determine. Because here's the biggest thing. Do you think that I called the restaurant to let them know that I'm not happy with it? No. Do you think anybody else has called the restaurant and said that they're not happy with it? No.
They go on Yelp.
Exactly, they go on Yelp. But you have to be aware of this stuff, and you will start to see trends that can start to, you'll start to see something happening, whether it be inventory rising or your sales dropping, and you're going, okay, wait a minute, what's happening here? Because that shouldn't be happening. Yes?
Are you looking for a decrease in inventory every year?
Not really a decrease. You're probably, year over year with a company, you generally are going to have a fairly consistent inventory amount. The only reason why you might have a little bit of an increase in inventory is if you had maybe a fairly significant increase in, say, prices. I believe it was last year or year before last year. There was a whole issue with eggs.
Yeah.
Do y'all remember that? There was a whole big issue with eggs, and the price of eggs went from like $3 or maybe two something to like $4.50 a dozen. Yeah, and now that the whole issue has been corrected, now the price of eggs are dropping. So in something like that, let's say that we're like a Waffle House type of situation. Waffle House, Huddle House, they sell a lot of eggs. So if we sell a lot of eggs and then we have this egg problem where I think it was salmonella that was in them or something, we're going to have a fairly significant increase in inventory. But otherwise, we should be fairly consistent over time.
Yeah, but sometimes you can't make things too expensive or too cheap depending on the way the customer's work has. And by supply and demand, if you make it too cheaper, there's going to be so much demand, but not much supply. You're running out of
Well, but the thing is too, though, now economics, the supply and demand of it is one thing, but the other thing that we have to keep up with is what are the current trends that are happening. Well, it's things like not only is it supply and demand of our product, but are people moving away from one type of product into something else? One of the big things in the food industry right now is everybody is moving to sort of a farm-to-table, organic, sort of mix and everything. And if a lot of these companies aren't really sort of keeping up with that, then they may see a drop-off in their sales. And adjusting their price isn't going to make a difference. It's all about the mix of the product that they're selling.
something out of my range. If someone sells something on Wikipedia,
Okay? So there's a lot of stuff when you're talking about all this supply and demand and economics and marketing and everything else. Accounting is where it all meets together and where we interpret the changes and the decisions that we've made.
Light bulb.
Love light bulbs. All right, so comparative, okay, on the liability side, let's take a look. Again, we're doing last year versus this year. We're showing an indication of decrease or an increase, okay? Now, how do you think we're looking on the liability side of the balance sheet?
There was a decrease in payables, that's good.
Okay, decrease in payables, that's good. We paid off more than we bought.
Income taxes went down.
Okay, income taxes, well, let's see, hang on. Okay, now, here's the thing, be careful here. When you're looking at the federal and state income taxes, this is the federal and state income taxes that we haven't quite paid yet. So remember, with the way that income taxes work for businesses is we calculate the income tax each quarter and then we pay it the fall, like before the 15th of the next month, okay? So this does show a decrease. Now, we can't say overall throughout the entire year that this is not a good thing, but what we can probably say is this. We probably had less net income or less taxable income here from last quarter to this quarter. Excuse me, last year's final quarter and this year's final quarter.
So is that positive or negative change?
That would be a negative change. Because if this is lower in the current year, that means that we don't owe as much in income taxes from this year's final quarter versus last year's final quarter. So last year's final quarter, we had a lot more taxable income than we had this year, which by default means sales are probably down, cost of goods sold are probably down, overall profits are probably down, right? Not good, okay? Anything else? About accrued payroll. What's accrued payroll? Do you remember?
Yeah, wages.
Okay, it has to do with wages.
But it's not.
Right. It's the last payroll period of last year that wasn't paid until January of the following year, right? So last year, it went from 9,200 to this year of 11,006. So we maybe either increase employee wages overall, okay, we could have given a lot of folks raises, or we have more employees. But we're kind of getting the feel here already, though, that based on this federal tax here, this may be a increase in wages that was justified or not. Because if the income tax is going down, right, that might mean that we've got too much cost being incurred. So then we have to ask the question, do we have too many people on the floor? Do we have too many people in the kitchen? Is the demand dropping, but we're still staffing at the previous levels? Yeah. Do we need to reevaluate our schedules, or is our wages too high? We got too many people? You see where I'm going with this? So you gotta watch what's going on here. But this is only gonna give us one piece of it. Then we're just gonna have to dig deeper and look into all the data that's behind all of this to say, okay, how many people are we seating during breakfast, lunch, dinner? Are we losing money at dinner? Are we losing money at lunch? Are we losing money at breakfast? Are we overstaffing during some period of time during the day? Are we effectively using our people? Okay. Do you have a question?
Sort of. I was gonna say, could it be like they're short staffed and so everyone's being paid overtime?
Okay, that's another good example, yeah. We might have too few people, and now to make up for the higher demand, we're having to keep them on the floor at overtime wages. That's a possibility as well. Okay. All right, let's see. Okay. last year's net income was, but remember, this retained earnings change right here, that's gonna be net income, okay, from this year less dividends, right? Because beginning retained earnings plus or minus net income minus dividends. So this 40,544 is going to be the income, the net income less dividends. So did we make money this year? Yes, and we can see that on the balance sheet even without the income statement.
When you say less dividends, do you mean that's already been subtracted out of it?
Correct. Okay. So this is where, again, this is where accounting gets fun.
This is
Oh, yeah, you see the
This is where it gets really fun. All right, now, let's take a peek, hang on. Let's take a peek at the schedule. Oh, and I need to confirm the seating chart here real quick. Hang on one second. All right, so you got a lot to do. You got a lot to do between now and Monday. So you need to get your reading done. You need to get your reading prep done. And we will hit the Chapter 9 practice problems on Monday, and then we'll have homework for Chapter 9 next week. Now, again, just realize if you've never had me before, we are really working through, we have an overlap between Chapter 9 and then Chapter 7 for the next one. So we're sort of working in tandem with 2 chapters at a time. So just be aware of that. Don't think that it's like, okay, we're only on Chapter 9 and I don't have to worry about anything else until then. So make sure that you keep your schedule rolling there. All right, the other thing, have I got, hang on, have I got everybody? You want to move up here? Okay. All right, is everybody good? Have I got everybody's name correct, spelling correct, and all that? Now realize, this is from my perspective. When I post it online, I'll flip it around from your perspective, so then that way you can start memorizing people's names. All right, and Tony is gonna move.
Most familiar face.
You gonna move up here in front of Ross or Julia?
No, man, right there, I'm going over there.
Right here? All right. Okay. Okay.